What's going on, friends? My name is Chris, and in this video I'm going to go over a big trading loss that I had on November 21st, 2024, trading Meta stock options. And I do believe that this video could give you some valuable insights if you're interested in trading options. Specifically, if you trade stock options, this video will give you some information. Now, just to give you some context, I've been trading since 2018, and I started trading options in 2019, took a pretty long break from trading them because I switched over to trading futures, and now I trade both futures and stock options, and now it's 2024 here. I have an established trading strategy, and everything I'm saying in this video relates to my trading strategy. It does not relate to the way that you trade and the way that you perceive the markets. So just understand that some of the things that I'm saying will apply to options trading in general. The others will be more subjective because they apply more to my specific style of trading and what I look for and how I prepare for my trading on the day. So if you're learning about options trading, or if you're a very seasoned options trader, I think that you guys will be able to relate to what I'm talking about in this video. Thank you for watching. I really appreciate it, and leave a like if you enjoyed the video. Thank you. So on Thursday, November 21st, 2024, I actually had one of my biggest trading losses in a long time. I don't normally take big losses or outsized losses. And of course, outsized losses are relative to how much you average gain on a day. So if you average, 2-3% a day gain when you make money, and then when you lose money, you lose 20%, obviously that's considered an outsized loss. Normally you don't lose that much in a day. Someone who's been trading and managing risk for a long time knows that these types of days do not come around very often. In fact, they come around very rarely, maybe once every couple of years if you're lucky. One thing to say about having big losses is that as you naturally progress through your trading journey, you're going to have bigger losses. Just as you have bigger wins, you're going to have bigger losses. You should never judge a trader by the size of their wins. You should always judge them by the size of their losses. And there's something human about taking a loss that everybody can relate to. When you talk about taking a loss, all of a sudden traders open their ears and they want to listen to what you have to say. I have to tell you guys about a few crucial mistakes that I made here trading stock options, and certain things that I really wanted to share because I definitely will not be making these mistakes again. And I am a believer in the fact that you need to learn things the hard way in order to properly learn them. Sure, you can learn a whole bunch of stuff watching videos, listening to other traders, copying all their style and everything. But once you get into the battlefield for yourself and you make the real mistakes and you get cut for yourself, that's really, in my opinion, what it takes to solidify your plan and to really never make those mistakes again, because you're never going to be caught doing that again. You do not want to be in that situation again, ever again. So you're going to make it a point to never get there again. The way trading works is that it's very cyclical. We have periods where we're on a hot streak. You might get a little overconfident and then you become a little complacent. You show up one day, you're not as prepared as you should have been, and that's where the recipe leans itself more towards messing things up and losing money. And what's very important is that on those days where you may not be as prepared as the other days, you have to use these days to mitigate your risk rather than trying to shoot more bullets than you have. Now, the first main problem that I had on this day when I showed up in the morning Thursday is that I wasn't as prepared as I normally am. Looking back on the months of October and November, I had a number of very good trading sessions, specifically trading 0-day to expiry options on Fridays. And when I traded these on the Friday mornings, I noticed that I always spent at least the couple days before that watching the markets, not trading, but just watching and preparing. Specifically on the Thursday evening, I would be looking at the markets at nighttime, studying and preparing for certain trade setups that might play out Friday morning. However, I didn't do this yesterday. I showed up Thursday and I really wasn't in the best state. So I pretty much showed up Thursday morning, started trading, and I was trading very loosely. I thought that looking back on the session, I felt I was trading very loose and my game plan wasn't as tight as it should have been. And obviously that's subjective. It's relative to what I consider to be having a tight game plan. For me, having a tight game plan consists of understanding my contextual levels for trading, which are derived from my supply-demand system, having a good understanding of multiple scenarios that might play out in the day, and preparing myself mentally for these things to occur before they actually happen. So that way, in the moment when I'm executing them, I'm just ready, and I'm ready to pull the trigger. I know what my risk tolerance is. I know approximately how much the options are supposed to be moving, etc. So I'm just overall more prepared for certain trade setups. Now, it doesn't matter how prepared you are, you can still mess up. But I do think that being prepared can help you stay out of certain trouble, like getting into situations where you have a few paper cuts, you start getting a little bit frustrated, and then all of a sudden you find yourself adding more to a losing trade. So let's talk about adding more risk to the table when it's not really a good decision to do, because that was the next big thing that I did. Now, you know, when you hear traders talk about you should add to your winners, but you should never add to a loser. Obviously, this is a little bit subjective, because there are certain trading strategies that actually profit and do better when you give yourself multiple entry points into the market and you kind of scale in and out of a position. So you might give yourself 3 entry points and 3 or 4 or 5 exit points, and you also use a little bit of discretion on top of that to decide when and where you want to be entering and exiting. The problem with this approach is that if you're not set enough in exactly where your stop loss is, you can easily get into the habit of adding more, and then all of a sudden it becomes a martingale strategy. And this right here, combined with the complexity of stock options, really could lean itself more to making big mistakes and having big outsized losses in the case that things don't work out and go against you. And I'll explain to you why I think that, because I'm going to talk a bit about strike price selection here next. I definitely follow the advice, which is you don't want to be adding to your losers and you do want to be adding to your winners. And I do this most of the time. However, everybody is subject to making bad decisions once in a while. And there's other reasons for it, apart from the fact that we know we shouldn't do it. Why do we still do it? Obviously, that relates more towards your psychology, your trading psychology, and I guess the topic of self-sabotage and becoming complacent. I'll talk a bit about that towards the end of the video. The next big mistake that I made on this trading session was bad strike price selection and trading product selection. So this loss that I took happened after a number of trades I had on the session that actually weren't so bad. So I had 2 trades on Tesla options that were small scalps that didn't work out. I just exited for small losses. And I had 1 trade, actually I was short Dogecoin Thursday morning, and that was the one profitable trade of the day. I was short Doge on a crypto exchange that I trade on. I had multiple scale in and scale out points on that trade, and it worked out just fine. And then after that Dogecoin trade, I started getting involved with Meta stock, Meta options. One of the reasons why I got into it was because the stock had dropped a lot on the day, and I thought there was potential for at least some more downside movement, but I was clearly wrong. We saw a big down move and then a big recovery, and then we were pretty much chopping in and out of these monthly longer time frame levels, and that's where it stayed for the remainder of the session. I basically failed to gauge the probability that we would have a V-shaped recovery and then end up right back in those monthly zones and just chop there for the rest of the session, which would essentially result in the put options all pretty much going to zero or close to zero and just not really being good trades. You don't want to be caught in put options when the market is slowly fading up. Really bad trade to be in. So that was the situation that I was in. I got myself involved in a put option trade on Meta, and then I failed to cut it for defined risk because when I got into the trade, my risk wasn't defined. That was a big issue. I rushed into the trade too quickly for whatever reason. I may have to go back and review my session to see exactly what sparked that, but I honestly think I just wasn't prepared enough for that particular trade. I wasn't focused enough on what the market just did and what it was currently doing and what the probability of what it was going to do going forward was. So I got involved in this trade, and then all of a sudden it started going against me, and I didn't panic initially because I didn't get into a very big position. But what I did do was I added more to the trade because I normally enter at least twice before exiting, and this is not the big problem. Problem is, after about 30 minutes to an hour after being in that trade, rather than deciding that I was just going to eat the loss and lose a couple $100 on the day, I decided that I was going to keep trading it, and I started to trade options that were more in the money. Basically what happened was I got involved in some slightly out of the money options on Meta. I got involved in the 550 puts when it was trading at about 555 or 556, and then the market started to rally a little bit more, and those 550 puts almost lost 50% of their value very fast. So I was down, a couple $100. I didn't have a very big position size, maybe about $300 I was down on that, which is not the end of the world. But the problem is I failed to eat the loss, and instead I tried to scalp around the trade, and then I decided to use more at the money or close to the money options to kind of mitigate the loss and scalp my way out of the trade. Turned out this was also a bad decision, because rather than eating the loss, I was using more options to put on more risk. So part of what I'm talking about when it comes to bad strike price selection is the fact that I bought out of the money puts expecting them to be in the money, but I don't think I was clear enough on what the real probability of those options becoming in the money was. And that's why I believe that selecting those 550 puts in that moment was a bad decision. And then I continued by trading the 560 puts a little bit later. And those worked okay for a little bit, but pretty soon after, everything just kind of went to shit, and I started losing on those too. So now I had my loss starting to snowball. Rather than the trade that I put on to try and mitigate it working in my favor, it just resulted in me snowballing the loss a little bit more. So now instead of sitting on a $300 loss, I was sitting on about a $600 loss. Now I want to talk a bit about trading product selection and bad strike price selection. So I have a customer of mine who's been doing pretty well trading SPY options lately, and I assist him with using Trader Workstation, which is Interactive Broker's main trading software. If you guys need any assistance with using that software, feel free to reach out to me, and I do have a remote assistance service you can check out for how to use that software. I've had one customer that I've been working with for about a month and a half now. He pretty much came to me with almost zero knowledge of trading options on that platform till now, where he's actually doing pretty well, and I'm pretty proud of where he's come up until now. That being said, he still has limited knowledge when it comes to a few things. So one of the things that I told him was that it's very important that he stays with the SPY options and he does not try and venture out into trading stock options like Tesla, Meta, or other less liquid options. Obviously, Tesla options are very liquid, but if you compare that to Meta stock options, there's actually a big difference. Meta options have somewhere between a 10 to 20 cent spread on the options, and they do not trade nearly, not even close to as much volume that goes through on SPY options or Tesla options. Now, obviously, if Meta stock is in play on the day more than the other stocks, then of course the options volume is going to be higher and the spreads will probably be better there too. But generally speaking, on the day that I was trading them, the spreads were very bad and the volume trading into the options I was trading was very spotty. So one tip that I can give you guys when it comes to strike price selection is obviously look at the number of contracts traded on the day for that option, number one. Number two is that if you plan on going long an option, meaning you buy an option, a call or a put, if you're buying an out of the money call or a put, try to make sure you're buying a strike price that you think could be tested or has a good chance of being tested at least once within the session that you're trading. And I know that could be very subjective because you don't know for sure the market's going to go anywhere, but based on your system of trading, if you think that there's a higher probability of the market trading at a certain price than another, it's recommended to trade options that you think are going to become in the money or stay in the money rather than going with out of the money options that don't have a high probability of being tested in terms of the strike price being tested. So one of the mistakes I made was the fact that I was going to buy 550 puts, but I failed to realize that the market may not and probably wouldn't go all the way back down to the low of the day. Based on how it recovered off the low, it did pretty much a V-shaped recovery and it kept grinding away from the low, which obviously slowly starts to increase the probability that the low of the day is in. And now if nothing happens for the rest of the day, those options are pretty much going to go to zero. And when I say go to zero, I mean like lose 70% of the value, and then the next day, who knows, because anything can happen overnight. So bad strike price selection and bad trading product selection as well. Trading meta stock with the bigger spreads on the options, it was just a bad choice. I've had some very good experiences trading Tesla options in the last few weeks. Maybe I found a bit of a sweet spot in my trading regarding those. So I think that I should focus more on what's working and try to cut out more of what's not working. And what that means for me is focusing more on strike price selection in combination with how my strategy works and how I enter and exit, which is stuff that I don't really go over that much in my videos. That's why I'm saying most of the stuff here relates to my trading, and a lot of the advice I'm giving you here could be very subjective to your trading strategy. It may not even apply to you, okay? Because for some other traders, they might have a reason why buying out of the money options is good for them. But for my trading strategy, buying out of the money options is sometimes very risky, because one of the things that happens with out of the money options is that the longer they stay out of the money, the more subject they are to time decay, which means they're just going to chop. And whenever the market goes in your favor, the options prices are not really going to reflect it as much as the underlying stock is actually going up. And that's what happens with out of the money options. Now, when you have a scenario where an out of the money option goes from being out of the money to being in the money, that's where you start to see some of those outsized inefficiencies happen in the options market, because the delta changes. If you got into an option when the delta was 20 and now the delta is 50, all of a sudden your risk reward on that trade has now shifted a lot. If it does continue going in your favor even another $1, it pretty much makes the risk reward work in your favor at that point, because if it does go another $1, you're not making or losing 20 anymore. Now you're making or losing 50. Now, one thing that was extremely tricky about this trading session was the fact that I got involved with these put options and I was down money and I failed to cut the loss to start. I failed to define my risk from the start. And now I was in a situation where I just had to eat the loss or let it play out and gamble more. And because I have a certain degree of trust in my trading abilities, meaning I do have some skills of managing trades. I've been trading for a long enough time that, if you give me a few hours with a market that's moving, keyword, it has to be moving, which it really wasn't on this day, I will probably be able to make something out of it. I'll be able to scalp in and out and do something with it. So I trusted in my trading abilities and I decided that I wanted to manage the trade and not eat the loss right away to try and mitigate the loss. This turned out to be a bad decision because I was already involved in a bad trade to start with, and the trade that I was involved in, it's not like just going long outright stock or going long or short an outright crypto or a futures contract. Now we're talking about options. The problem with options is that the longer the options stay out of the money, every time the market moves in your favor, so if you're long put options, every time it goes down a little bit, if it doesn't go down far enough, the volatility doesn't go up, which means the option price will not increase. In fact, the volatility might be going down or just staying steady and then slowly fading away. Because keep in mind, this is after 11 a.m. going to lunchtime on Wall Street. The probability of volatility contraction is higher than volatility expansion, especially on a day where there's no news. But I still decided that I wanted to play longer and see if I didn't have to eat the loss or if I could mitigate the loss. But it was a mistake because there were so many factors working against me, and I just named some of them. The fact that we're going into lunchtime, there's no news for the rest of the day. We had considerable volatility on the open. There's a lot of volatility and open interest in those put options. But what's the probability that we see more volatility expansion? I would say pretty low compared to what we just saw. So I failed to execute on the fact that I probably had no choice but to eat the loss, and it could continue to get worse and worse throughout the day. And that's exactly what it did. It continued to get worse, and it just chopped its way higher, and I just eventually had to just eat the loss. And the problem is that not only did I just leave the trade on, but I continued to trade other options all throughout this, trying to mitigate the loss. And I think that some of this stems from slightly overconfidence in my own abilities, and it also stems from fear that if I ate the loss, the trade would then go ahead and work out right away and I wouldn't be in the trade anymore. And this is a very common fear to experience as a trader, even if you have lots and lots of experience, because you kind of want to, it's a bit of an ego complex. I personally think there's nothing wrong with having an ego, because ego means you have a degree of confidence in what you're doing. You view yourself a certain way. That's pretty much your ego. The fallacy with this is that if you have a fear of eating a loss just because you think that as soon as you eat the loss, the market's going to go in your favor, then you're probably not confident in your trading strategy, or as confident as you think you are. Because if you were as confident in your trading strategy as you think you are, you would eat the loss and then continue to trade the market from a clean slate. But because you don't want to accept the loss, and you think that as soon as you exit the trade, the market's going to go in your favor and work out, it means that you're not confident in your ability to get back into the trade if you have to, which is completely false, because I am confident in my abilities to do that, and I've done it many times. So I'm just going to recap some of the mistakes. So some general trading mistakes from the beginning of the day. The first thing is, obviously, plan wasn't solid enough. Second thing is, the first 2 Tesla scalps, they were 2 losses, but I exited quick like I normally do, and these were okay. They were just lower probability in hindsight because I believe I wasn't as prepared as I should have been. The second thing is, when I started trading Meta, I entered the trade without defined risk. I didn't know where my stop loss was. I guess I just messed up. I messed up fully. I didn't know where my stop loss was. Pretty soon I was down a couple hundred, and I was like, why am I in this trade? And then I just, instead of getting out and just eating the loss and saying, wow, I just fucked up, instead I just continued to play the game and I didn't cut the loss. And I was like, well, let me try and fix this. I decided that I was going to try and fix a loss rather than just cut it and realize I fucked up. And obviously, when I put it in those words, anybody in their right mind, when they get into something and they realize they made a big mistake, they're gonna just stop and eat whatever the loss was. But in this case, because I just wanted to keep playing or something, I decided that I didn't have to eat the loss for whatever reason until later, which was a bad decision in hindsight. I do think that the market can really, really bring you on a roller coaster ride if you are not prepared for what you're going to do. That's why I think that every trader should have a good degree of understanding and preparation of what they're planning on doing, what they expect from the market on the day. And also with that, understand that the market could do anything. Some things that you may not be expecting. So you have to account for things that you're not expecting too in your visualization and your preparation process. And I clearly wasn't prepared enough for any of this in this session. I just woke up, turned everything on, started trading almost unconsciously, kind of like almost pure fight or flight, which wasn't very good. Okay. The next rule that I broke and that I'll never be breaking again is that I selected a strike price that the market may not test by the time I plan to exit the trade. And I know this is subjective, but for my strategy, this makes a big difference, because if I'm going to go long an option, I at least want to see the market try to come close to testing that area. Based on my system of how I categorize my entries and exits, a lot of times when I'm trading them intraday, if I select my options correctly, I see those options get tested. They may not get fully tested. It might come right before the strike price and then move away. I don't need the strike price of the option to get fully tested. All I'm saying is that because it's closer to the money, the delta figure is going to shift from being 20, 30, 40, 50, or from 50 to being 20, etc. And obviously there are other things that go into strike price selection that I may not be covering here because there's a lot to it. There's a science to this. And then of course the biggest mistake I made was that I continued to trade Meta in an attempt to recuperate losses while using options with a higher delta, just putting on more risk in an attempt to recover a loss when you should be mitigating it. One thing I was talking about to my client today, he's been having a few good days in a row now, and he asked me, he's like, what do you think about making, say, $2,000 a day? And I was like, well, it doesn't really matter how much you make a day as long as it's in line with your risk tolerance. Because if you're risking 5,000 to make 2,000, that's eventually going to catch up to you, and you're going to probably blow that account up and lose all your money. But if you're risking a couple $100 and then you lose a couple $100 a day, and then one trade makes you 2,000 and makes up for like 5 or 6 paper cuts, in my opinion, that's a better scenario to be in. That's where you can actually develop a real edge. And having looked at a lot of my trade statistics over the years, that's often a pattern I see. When I'm in a scenario where I'm taking a lot of paper cuts, as long as I continue to persist and I don't let the losses get out of hand, I typically end up coming out of the other end of the tunnel, with a bunch of big money bags in my hand. Obviously, it's an expression. What I mean is you get one big trade, as long as you're there for the trade and you have enough conviction to keep executing until the trade works, you end up with one trade that makes up for 8 or 9 or 10 of your losses. Of course, those small losses have to be paper cut losses. They can't be big losses. I'm not a big believer in taking big losses. I never was, because once you develop the skill set of trade management, of scalping too, I want to say scalping because scalping means you have the ability to trade around the price action and to kind of, if X, Y, and Z is true, enter. If X, Y, and Z is false, exit. And then if it becomes true again, enter again. And then if it false, then exit again. And you could get chopped up doing this, but there will be a time where the market will go. And if you're in the trade, you want to make sure you're in the trade for the time that it does go. Now, I want to tie this into strike price selection, market selection, and the bid and ask spread of the option. Because if you're trading an option that has a wide bid and offer spread, 20, 30 cents, and there's not a lot of volume going through it, it's only trading a couple of contracts every few seconds, doing what I just said there is going to be way more difficult because you're not going to be able to be in the trade by the time the market goes. Again, the condition might be false and then it's true again, but because of the nature of that market, because it's not liquid, the market's just going to go. You won't be able to get in the trade unless you hit the offer to get in, which means you're giving away a big edge because the spread is 30 cents. You're giving away $30 a contract. You're trading a 10 lot position, $300 just to enter the trade. Ouch, not my cup of tea personally, okay? Whereas if you trade an option with a reasonable spread, maybe 5 to 10 cents at most, or 5 to 15 cents, and there's enough consistent volume, because all we really care about is consistent volume. If there's consistent volume on the bid and on the ask, the spread could be as wide as you want, but as long as you're able to enter somewhere closer to the bid, you can probably sell to somebody on the ask and just scalp off most of the position fast, or at least a partial. You understand what I mean? What I was talking about there in regards to taking paper cuts on a trade, or being willing to take paper cuts for the potential that when the trade does work, you're in the trade for the long haul. That only really works if you're trading options that have good enough volume trading in real time. You know, I ask myself, why did I allow this to happen? And obviously the answer to that question is not as easy as you might think. When you're a beginner trader, here's the difference between a beginner and experienced. Beginner traders are quick to find reasons to the mistakes they made. Oh, it's because the price action did this and that did that, and they think they know the answer to everything. But the deeper you go into your trading journey, the more you realize that the answer to this question, why did I allow this to happen today, is a lot harder to answer than you think. Now, a couple things I'll say on this is, I think I may have needed a bit of a wake-up call. And what I mean by that is, I guess I just became a little bit complacent, and I underestimated the probability of how bad things could get. And of course that means I was complacent. How did I get complacent? Well, when you've been doing well for a while in multiple areas, not just in trading, you could get into a state where you become a little bit complacent and you start to put less weight on the negatives. I saw an interesting interview of a trader a while back on YouTube. I don't remember who it was, but I remember him saying one thing which resonated with me, is that you should always have a certain degree of fear of the market, meaning you are fearful of the market because at any moment it could do something really crazy that you're not expecting. So I think that, you know, you could call it fear if you want, you can call it fight or flight, but when you're involved in the market, you have to have a degree of fear, because you know that at any moment it can do something that you're really not ready for, that you're really not expecting, and it can go completely against you and it can get a lot worse than you thought. And if you're complacent, you're disregarding the fact that that could happen. So that's why I think having at least a little bit of fear in regards to that is good. It's good to have fear. It's normal to have fear. You want to have a lot of confidence and conviction in regards to executing your trades, but also you need a little bit of fear because that keeps you from being too complacent and ignoring the fact that the market could go completely against you, continue to go against you all day, and maybe even wipe you out totally. So when I talk about, you know, you need a wake-up call, it's really kind of a complex topic because it also kind of relates to self-sabotage. I like to talk about the springboard theory a lot. The slingshot theory is when you're on a high horse, it's pretty common to revert back to being your regular self. So let's say you've been doing very well for a few weeks. If you haven't been doing well out of the fact that you needed to do well and it just kind of came out of nowhere, there is a possibility that you are becoming a little bit complacent, which could result in you having the natural slingshot, which will bring you back to your mean, so to speak, which means that you get off your high horse real quick and you get one or two losses that bring you back to reality. And that's it. And then the last thing I wrote here is that sometimes you need to actually go backwards to propel yourself forwards. I actually like this idea a lot because there are some times where you just feel like you might be in a rut and you feel like you can do no wrong, but then all of a sudden things just kind of come to a halt and you don't know what's wrong. And that typically requires you to really figure out what's wrong before you can move forward. And in the trading world, this means you're going to have to take a few big losses to kind of get that wake-up call to be like, wow. So then you can start piecing things together like I'm doing here and trying to go to the root of the issue and determine, you know, why did this have to occur, or why did these things have to happen to me in order for me to make that realization? But I just find it's pretty normal that sometimes you have to go backwards in order to go forwards in life. So, you know, when traders ask what's a good starting amount in trading, and Over the years, the answer to this question has become more and more clear to me. It's that when you're starting, you want to start with the least amount possible. The problem is that this amount is subjective for everybody. So for somebody, $5,000 might be considered not a lot of money. It might be considered nothing. But for someone else around the world, that $5,000 is considered a lot of money. If they lost that today, they would lose their livelihood. For them, that money is a lot. It's all relative. So when you're first learning trading, I would say it's good to start with a small amount. When you lose in trading, you should be losing amounts that don't necessarily make you go crazy. In the sense that so whatever is considered a paper cut for you. So for example, a paper cut might be $20 or $50 or $100. For me, that's a paper cut. So if I take multiple paper cuts, they can add up after a while. But I think of it as each of those paper cuts is a cost to play the game, because one of those shots, one of those entry tickets, has a probability of doing 4x the risk, 5x the risk, 3x the risk, etc. So that's the way I think of it. You have to trade around your risk tolerance. I don't mind taking 3 to 6 paper cuts on a trade as long as the criteria for my trade is still there and I understand the narrative and the potential behind that particular trade on a high level. Then those paper cuts are simply the cost to play the game. That's how I view it, okay? So as you become more experienced in your trading, mistakes cost. This mistake costed me $2,500 US. Back when I was trading, 4 years ago, that amount was around $500 or maybe a little less. When I had a day a long time ago where one of my old accounts got liquidated because I was in NASDAQ futures and it went against me like 300 points or 400 points. I don't remember the exact amount. That day for me was one of the biggest losses I ever took about 4 years ago. I think it was in 2020, if I'm not mistaken. As you become more experienced, the mistakes that you make end up costing you more money because your risk tolerance has gone up a lot. So, be aware of that. It's good to make mistakes when you're learning, so that way you don't make those mistakes again later. However, even that I don't think is so productive to think about, because you're going to make some mistakes no matter what. You just want to stay away from the mistakes that are going to cost 20% of your account every time, and that's what I did today. So I hope that any of you guys who trade options got value out of this video today. If you guys want to learn more about the service I offer for helping users transition from platforms like Thinkorswim to interactive brokers, check out this video right here, and check out this playlist right here for a whole bunch of interactive brokers platform tutorials that can help you to master the software. Thank you for watching. I'll see you in the next one.